warriors of price action and guardians of fundamentals. Welcome to Retail Recon. On today's option series, we're tackling short puts. Selling put options to collect premium while potentially acquiring stocks at a discount. The objective is clear. Understand how short puts work, when to use them, the risks involved, and how they differ from the covered calls we covered in episode 15. So gear up and let's go to work. If you remember from our options foundation episodes, a put option gives the buyer the right to sell you 100 shares at the strike price. When you sell a put, also called writing a put, you collect premium upfront, but you take on the obligation to buy those shares if the buyer exercises the option. In simple terms, you're offering to buy the stock at the strike price. If the stock stays above that strike by expiration, the put expires worthless. You keep the full premium as profit with no further obligation. If the stock drops below the strike, you might get assigned and you will have to buy the shares at strike price. But since you have already collected the premium, that lowers your effective cost basis. Key point number 1. Short puts are mildly bullish to neutral. If the premium is your main target, you want the stock price to stay above strike so the option expires worthless. You might also be after the stock. In that case, you will get it at a discount to the current price, sweetened by the premium received. This is different from covered calls in a fundamental way. With covered calls, you already own the shares. With short puts, you don't own them yet. You're committing to potentially buy them. For that reason, selling a put will have an impact on your margin. I generally advocate to have all short puts cash secured, meaning you have enough cash balance on your account to cover the assignment. The risk profile is similar to short calls. Your downside is theoretically unlimited. Let's think through it from both sides so it's crystal clear. The put buyer pays you premium because they want downside protection or because they are placing a bet that the stock will drop. They're hoping the stock falls below the strike so they can sell you the shares at the strike and above the current market price. You, as the seller, want the opposite. You collect that premium upfront and hope the stock stays stable or rises. From the buyer's view, if the stock stays above the strike, it makes no sense for them to sell to you as they can sell higher in the market. They will let the put expire worthless. Quick side-by-side comparison. If you buy a put, you're betting on a big drop and your max loss is the premium paid. When selling puts, your income is that premium, but you face potentially larger losses if the stock tanks. That's why position sizing and stock selection are critical. Let's walk through a concrete example. Say Microsoft stock is trading at $4.14 per share. You like the company long term, but think it will trade sideways or slightly higher over the next 30 days. You sell one put contract with a 405 strike expiring in 30 days, collecting $1,055 premium per share. That's cash in your account immediately. Your obligation. If Microsoft drops below 405 by expiration, you buy 100 shares at 405 each, but your effective cost basis becomes $394.45 because you already collected $10.55 premium per share. Now let's look at 3 scenarios at expiration. Scenario 1. Stock stays at 415. The put expires worthless. You keep the full premium. That's 2.6% return on the $40,500 cash you needed to have reserved at the 405 strike. No shares bought, pure income. This is your ideal outcome. Scenario 2. Stock drops to 400. Assigned. You get assigned and buy 100 shares at 405 strike. But with $10.55 premium already banked, your effective cost basis is $394.45. You collected small profit and you now own shares you wanted anyway, bought at a discount price. Scenario 3. Stock crashes to 350. Painful assignment. Assigned at 405, share is worth 350, so unrealized loss of 55 per share, cushioned a little bit by the premium received. You can hold for recovery if you believe the price will recover or cut losses. This shows the real risk. Downside can be very painful. For that reason, I sell puts only on the shares I'm prepared to own or at least use them for several rolling trades. This assumes cash secured puts. If you don't have cash reserved and use margin, losses amplify. If you are just starting your trading journey, stick to cash secured until you master the mechanics. Since we covered calls in episode 15, let's compare them directly. Both strategies sell options to collect premium and have similar profit-loss profiles. A short 45 put with $2 premium creates the exact same payoff as owning stock at 43 and selling a 45 covered call for $2 premium. The difference is capital efficiency. Short puts require less upfront cash compared to covered calls, as covered calls in the case of buy right require purchasing the shares. Cash secured puts will affect your margin, but technically that cash is not locked in. You can still use it for trading. From psychological perspective, selling puts feels riskier because you're committing to buy rather than already owning. From a trade setup, they both shine in neutral markets. You profit when nothing dramatic happens. When short puts work best? First, with stable or rising stocks where you wouldn't mind owning shares at a discount. Perfect for quality names temporarily pulled back. Think dividend aristocrats or blue chips. Second, post-earnings when implied volatility crashes. Premiums shrink after volatility crash, but if you believe in the company, it's cheap insurance to potentially buy lower. Third, when you have a specific price target you'd buy at anyway. Instead of waiting for your limit order to get filled, you collect premium while waiting. Couple of danger zones to avoid. Weak, falling stocks with no fundamental case for recovery. Highly volatile stocks before earnings. Anything you wouldn't hold long term if assigned. Meme stocks or hard flyers with no margin of safety. A word about position sizing and risk management. Always know your pain tolerance and calculate cash needed for assignment upfront. For a 45 strike, reserve 4,500 cash per contract. My rules of engagement as a default state never to deploy more than 10% of capital and risk more than 2% of account on any single position. I do deviate sometimes from that rule, but my safety mechanism is I can only hold one position higher than 25% of capital at any given time. That is complemented with the hard rule that no position can be greater than 40% of total capital. Bear in mind, risk rule still applies, even if the position is bigger than 10%. Choose strikes 5 to 10% below current price for decent premium versus low assignment odds. Shorter expirations balance theta decay with avoiding long-term directional risk. If you're unsure what those terms mean, don't worry, we will cover them in one of the future episodes. For now, just remember, as a seller of an option, time works in your favor. A word about exits. If the stock drops hard towards the strike, consider buying back the put and closing the position. There is also an option to roll down. Just to mention, I have a hard rule in my trading framework, and that is I always close all open positions on a stock if it drops 10% below my target price. From my experience, hard moves down tend to continue, so in majority of cases it is better to close the position than experience slow bleed. Real risk isn't assignment, it's tying up capital while better opportunities pass by. A couple of common short put mistakes: selling strikes too close to current price. Chasing fat premiums on trash stocks you'll hate owning. No exit plan, riding puts deep in the money praying for the bounce. Oversizing the position. Ignoring implied volatility, selling into low IV grinders yields pennies. Forgetting broker margin requirements. And biggest killer, selling puts on stocks you wouldn't buy with cash at any price. If you hate it naked, don't marry it via assignment. I would also avoid short puts entirely when markets panic. VIX spikes mean assignment risks explode. Avoid trading short puts during bear markets and on illiquid underlyings with wide spreads. Let's wrap up this episode. Short puts turn your willingness to buy stocks at discount prices into premium generating missions. They are perfect for neutral conditions on quality names you'd hold anyway. Always have your risk defined and manage exits. Personally, unless my objective is to buy the stock, I will close short puts when they reach around 70% profitability. On our next mission, we cover adding and reducing exposure, how to scale stock positions smartly without blowing. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.